Welcome back, everyone, to the channel. I'm saying it that way in particular because I'm not sure if this is going on LitecoinLeader or EconomicLeader. I might put it on both. We'll see. But I wanted to get this video out first because there's a lot of videos I need to make after this weekend. Okay. We had a ton of information happen, and it's still happening as I'm recording Sunday night. So I'm trying to get these videos done and out there. And that's why I'm thinking, hey, I've got 2 channels. Maybe I'll put this other video on there first. I don't know yet. We'll see. But the first thing I wanted to do tonight was to explain, because everybody's talking about the banking system, I wanted to explain how do banks make money, or how do they make currency? How do they increase their own wealth? What is their job? What is their role? Now, if you've seen The Hidden Secrets of Money by Mike Maloney. If you have not seen that series, I highly recommend it. It goes over the history of banking and fractional banking, which we'll get into in a moment. But let's talk, and I'll put a link up here as well to Mike Maloney's series. It's a series of videos. I think it's like 10 of them, and about half hour each. So it's about 4 or 5 hours of time that you're investing. You can watch it probably at 1.5 times, but it's really worth the education that's there. That's high quality videos. I actually know somebody that worked on the videos, and they turned out really well. Mike spent a lot of money on currency on developing that project, but he did a fantastic job. So in this series, especially in episode 1, he talks about the history of money and where it came from, and then the further episodes like elaborate more. But it goes over this financial system that is currently in place and how banks make money. But the current banking system that exists today, with the Federal Reserve that's existed for over 100 years in the United States, and the central banks that go all the way up to the Bank of International Settlements that exist on the globe today, that is an evolution of the banking system that's happened for a long time since banks started existing. So back in the history of banks, the idea of where banks make money, the original plan of banks to make money was that gold and silver were heavy and hard to carry around all the time. So what they would do, they would be a security place for people to store their value, their wealth, and usually in the form of gold or silver. And the bank would secure that location, and there would be a fee to do that, and they would exchange an IOU. So if you brought them an ounce of silver, they would give you an IOU, an ounce of silver, back to you, and they'd also charge a fee at some point, either in the first exchange or the second, probably the first exchange, for that, the privilege of paying the security and so on, of having that account there, having the silver store there, and so on. Well, as banks evolved over time, they noticed that fewer and fewer people would come and redeem their IOUs and get their actual silver and gold. They would actually just trade those pieces of paper, because there was a market for them now. This piece of paper is as good as gold. That was the phrasing. So if I have this piece that's like this piece of paper that says this is worth an ounce of gold, you can go to the bank and redeem it. Then people can just exchange those, and just there's an economy that happens. There's a marketplace for those notes. So once the bankers noticed that this market developed and existed, they said, you know what, we could probably issue more notes, more IOUs than what we actually have in reserve. This became known as fractional reserve banking. So the common practice now, I think it's a factor of 10, is that if you put $100, let me go back to the old days. You put 100 ounces of gold into the bank. Under fractional reserve banking, which is the term today that they use, it's still allowed for the banks that are in the Federal Reserve System, they only need to keep a certain amount of assets unleveraged. I'll say so the rule, I'm going to go with a factor of 10. So if you bring $100 to a bank, I'll say Bank of America because it's probably one of the most well-known, but pick any large bank and it works. You bring them $100. They are allowed through the banking system to lend against that $100 $90 immediately. So they take that $100 that you deposited, and they can immediately loan that $90 out and get that money working and hopefully increasing in value. So what the idea is, all right, if I bring them $100, that $100 is now in their possession. and that $100 they can loan $90 to the next guy that comes in that needs a loan, and then he's going to pay interest on that, and then they might sell that loan, and then they'll have more assets and so on. So number one is fractional reserve banking. That's how you get more and more loans against your reserves. So now, and there's a percentage number on the reserves. Secondly, they also have assets. Like whenever you have, like a company has assets and liabilities. When you actually deposit money into a bank, it's a liability to them, not an asset, because they owe you money back. You can come and demand that money, that currency at any moment. So if you put $100 in your account, you can come tomorrow and say, hey, I want my $100 back. You could do that. But what they're allowed to do is they're allowed to lend against that, and they need for them to make a profit, whether I'm saying currency or money, for them to turn a profit, they need to take those deposits and put them into assets on their books that increase it of value or a rate that's higher than what they owe back to you. And this can also cause I think it's time displacement. Well, it's not time displacement, but there's not a alignment of like, okay, I can go get my $100 tomorrow, but if the bank goes and buys a 10-year mortgage or 10-year treasury bill with $100, then they have to wait those 10 years to get like all the money back, right? All the value back. So I'll get to that in a moment. So the banks are the way they would make a profit is by fractional reserve and by buying assets that grow at a different rate than the current marketplace. So if they're paying 1% interest, which I know most banks aren't, let's just say they're paying 1% interest on all deposits. They need to loan money out at say 7 or 8% so that they can make a difference on that spread. And they're making 7 or 8% on that money, on that currency that they loaned out. And in addition to so that's above the 1% they have to pay. So that's how they eventually make things work out. And they have to rely on the trust that everyone is not going to go and demand all their currency back all in the same day, which creates a run on the bank. So that's what we're kind of experiencing these days right now we have two banks and probably more as they kind of cascade together, because banks often work together and they have exposure. They try to mitigate their risk and spread their risk around as much as possible whenever they can. That means including deposits or owning assets in other banks too. But what has happened in the last couple of years, and I'm going to talk about this in another video about what's happening with a couple certain banks that are going under right now or just did. But if they get too many deposits, right? They have too many liabilities, right? Now they need a place. Whenever a bank gets a deposit, it needs to put that money somewhere. So if I go to them and give them $100, they would love to be able to write a $100 loan. But when interest rates go up above what they're normally at, they have trouble making loans because people don't want to borrow money at the new higher interest rate. In addition, when they get a whole bunch of deposits, if they don't know where to put the money and the interest rates are low, they don't know where to put the currency. Money, currency, apologies for mixing those two. But if they have a whole bunch of dollars and they have no place, like they don't see a good thing to buy, like they don't know where to put it in, or they're not allowed to buy it in certain things, they may have to go to the most conservative things that are out there, which are treasury bills. And those can be at 1 or 2 or 3%. Okay. And that's what has happened the last couple of years when all the stimulus money came out in 2020 and 2021. All of these funds were now available in the banks, but the banks were over deposited, if that's even a term, and they couldn't afford. They couldn't really buy anything but the treasury bills that backed the currency that was being printed in the stimulus in the first place. So now what has happened is that banks who own too many of those treasury bills from 2020 or the period where they were only paying 1 or 2% and they had to buy those treasury bills have gone down in value, because you can get a brand new treasury bill now that's in the 3 to 5% range. So why would you buy a 1% treasury note when you can get one that's paying at 3 to 5%? Which means the ones that are 1% are actually have lost value. So that means that asset has lost value. So a bank who put $100 into a 1% T-bill may only have on paper that T-bill being worth $95, because you're getting, even though you put in 100, you're expecting getting 101 back, because 1% back. I'm just making math simple here. If I could put $100 into a new treasury bill now and get 105 back in a year instead of 101, Well, then I probably need to sell that 101 future payment on that old treasury bill for $95 to make it comparable to the other one. So now that's a 5% hit that you're making on your books. And that's what banks are experiencing who had to buy all these old treasury bills. So that's just the tip of the iceberg on what's going on with the banking. And I'll be talking a lot more about fractional reserve and lending and bail-ins. And I've talked about bail-ins a lot. We just talked about bail-ins quite a bit with Jack from Nobody Special Finance over at EconomicPreppers. I'll try to link that video up here as well. You can check that out. Subscribe to all these channels too. But I've got a lot to talk about a lot of banks, and there's a lot going on this week. But I wanted to get started with this one video, get it out there about banks and what do banks really need to make currency and turn a profit. And because it really ties into all the rest of the stories that are happening at the end of last week, and they're now happening this week. Here we are in the middle of March. Beware the Ides of March. Let's see how this plays out for the banks that have either gone under or precariously right at that pivot point where they could go under as well. So let's see how it all plays out. But as always, I love reading all your comments. Like, share, subscribe, hit the notification bell, all that cool stuff. Really appreciate that. So, but with all that said, I'm going to close the drawer in the bureau on this one. Say follow the leader, and I will talk to you soon. Take care.